All right. Good afternoon. So let us look at deduction now. So for this class, we are still catching up a bit, but no worries. So we are able to do it. So today we start looking at deduction for series tax purpose. Deduction. Now we have two deduction concerns. One will be the general rules. General rules, let me say it again. So general rules is going to help us to deal with unknown situation that we don't have any experience before, but using the general principle will help us to deal with this unknown situation. So we have to make a decision, make an informed, make sense decision in compliance with the legislation. Now first we look at the general deduction rule first, then we turn our attention to specific deduction like self-education expense and then a bunch of concessionary deduction one by one. So give you a rough idea. General deduction rule and specific deduction items. So let's go through general deduction rule. Two hurdles. So according to section 12(1)(2). So the legislation corresponding provision under the tax law section 12, which govern the deduction rule called adjustment of income. So adjust your income downward if the taxpayer incur outgoing or expense. In what way? Other than, so I highlight in red, other than, so it's a painful way that tells you nothing, okay? Not nothing, tell you in a negative way, okay? In something apart from this, then you pass. Apart from what? Apart from something domestic, private, and capital. So that means if you incur expense that is domestic, denied, right? Other than. If you incurred expenses, private, denied, capital, denied. And then we come back and look at the first hurdle. So what does it mean by domestic? How is that different from private? Now, domestic refers to household expense. Household. So you paid for your family. Domestic. Domestic. Okay, domestic helper. Okay, so the one that help you to take care of the household core. Domestic helper. So anything in your family is not just you as a taxpayer, but your family. Okay, including what? The grocery, the utility bills. All right, these are domestic expense. Denied. Private will be your personal. Okay, one-to-one, talking about taxpayer himself or herself. Entertainment, okay, pay for his or her own. Any other living expense. So long as your private, personal, domestic, even not for your personal alone, but pay for your family, deny. Okay, learn to use the word deny, reject as a allowable deduction. And then capital expense, also deny, because it's specific under the general rule, deny. Shut down by the first hurdle. All right, so essentially, capital assets expenditure, denied. But for our purpose, there may be a chance to depreciate. Now, this is something I would like you guys as a college student and you learn tax, even as the first course of your program. Then I would like you to get some interesting and yet technical thing before you graduate. Now, under series tax, under the tax law, it allows depreciation for series tax series tax payer, which is kind of, I don't know, strange. Is it strange to you guys? Individual subject under employment, he or she will be able to claim depreciation on assets they employ. Possible. So long as there is a one condition. So the asset actually is a necessity. Now, it must pass through by nature. It's necessarily incurred. That means you spend a couple $1,000 or even sometimes $1 million. Okay, the amount is not necessarily relevant. So you're spending X amount of dollar on an asset which necessarily required. Facilitation is another thing. Okay, so there were arguments So by nature, it's really a facilitation asset or it's a necessary asset. Now, if it's a necessary asset, you can depreciate. But it's an asset only for facilitation, no, you cannot depreciate. You simply deny, full stop. Okay? I gave you one example earlier, this one. Okay, hope all of you remember. So it's a pointer. Pointer is an asset. Okay, it's an appliance. So I bought it 800 Hong Kong. It's capital. I will not get the deduction because it's capital. Am I able to get depreciation on the 800? No. Why not? So getting to the discussion I gave you earlier. So what's the distinction? Facilitation versus a necessity, right? What do you think? I bought 800. You argue is a necessity or is a facilitation? I briefly told you it's facilitation because I can still use my finger. Remember that? It's not a necessity. Therefore, it's a capital expense denied. And I cannot depreciate under Section 12(1)(b). This is something I've been using. But one thing I did not tell you though, actually I upload the Board of Review case if you're interested. It's my favorite Board of Review case, D704, which I also briefly mentioned. I can't remember whether I've told you in this class. So it's about a musician spent 150 US on a violin. He was able to claim the depreciation on that violin because the board members introduced this objective necessity concept. Okay, so for this kind of musician that required to reach this level of artistic performance, require nothing but this violin and help him as a concert master under employment, then he was able to depreciate that violin. Okay? There's a one in my lifetime so far I came across by reading a Board of Review case. A series taxpayer was successfully claimed depreciation on an asset. Is it okay? D704. Necessity is a requirement. Bear in mind. Which is different from facilitation. Now, second hurdle. Outgoing and expense. Outgoing refers to your actual out-of-pocket, out of your bank account. Outgoing. Expense will be under your books and records. You incur that expense under a business operation. Okay, so no matter the way you pay, either out of your pocket or out of your bank account, or in a company situation, so you incur, okay, under your matching concept, under the accounting books and records. So you incurred an expense. No matter what the form it took, they should be deductible if they are wholly and exclusively and necessarily incurred in. Okay, so these are the important elements that underline for you. It must be wholly incurred in, must be exclusively incurred in, and necessarily incurred in. Now, if you look at each one of them one by one, altogether 4 components that we're going to talk about. Wholly. Wholly means 100% on the amount. On the amount. Wholly. So in other words, we are claiming $100 on the table, part business, part private. Part business, part private. So situation like if you're allowed to work from home, okay, you pay rent. Or you work from home. So there's some expenses. So it's both business and domestic component. You incur 100. The question is it apportionable? Now you have the answer. Because we just talk about wholly. So that means no apportionment. No apportionment. Dealing with expenses, part business, part employment, and part personal. So either you convince the assessor you deduct the whole thing, or you deduct nothing at all, wholly. Get it? In terms of amount, no apportionment. Exclusively. Now, exclusively, again, 100%, but this time 100% on purpose. So that means single sole purpose. Sole purpose, only purpose incurred in the production of income chargeable to tax. So if you spend something for multiple purpose, okay, again, part employment, part private, then you will get a denial of deduction, because the law says exclusively with the sole purpose. And necessarily, so we've just gone through, okay, different from facilitation. Necessity, as in necessarily. Again, incurred. Not just incur along the way, but incur in. Okay, 4 components combined. Make it very difficult for a salaries taxpayer to get a deduction under the tax return. Very difficult. Only a few things as an employee under salaries tax will be able to deduct. Now, before we get too frustrated about this idea, now bear in mind it's kind of fair. My reason for explaining it's kind of fair because imagine you're an individual under employment. If the expense is so necessary that you need to discharge your employment duty, do all of you agree it should be paid by your employer, not yourself? Because you're not running your own business. Agree? If it's so necessary, that means, okay, going back to the 800 pointer. So actually, I should ask my boss to buy one. Even that one may not be the one I want, so-called. But that's the reality. Is it good? Now, before you get too frustrated and think, oh, okay, it's not reasonable. Okay. It's reasonable, I would say. Notion. If it's so necessary for you to spend that X amount of dollars to discharge your employment duty, those expenses should be covered by your employer, not you. Okay, that's the idea behind the strict restriction under the deduction rule in general. So let us walk through a few examples. You can get a lot more examples by reading the textbook. The exercises that we're going to do together, so these are not deductible amount, leaving the last one as deductible. I will walk through the reasoning behind, which is more important. Now, traveling expense between home and office is not deductible. Now imagine, so you report the duty and you have a job, let's say 9 to 5, and you need to take minibus, bus, MTR, okay, altogether 100 per trip, coming back 200, let's say. So daily you incur 200 traveling expense from home to office, office back home, not deductible. Reason. Major reason, not incurred in the production, because you paid 100 before 9 o'clock, right? And you pay another 100 after office hour, you go back home. Before and after the production of chargeable income. Major reason. Follow? Okay, don't joke with me and say, okay, so it's 9 to 5, I purposely, arrive office at 10. Now, that's you're late, and it's still not deductible. See what I mean? Simply, you're a latecomer. You're not incurred that because you're late. Okay? What other reason? Some practitioners argue it's not exclusively as well. Because imagine once you walk through that main door of your home, and then you walk through your main entrance of your office. Actually, you can go anywhere. Okay, so there's no single destiny that you must go home, you must go to office. So at least perhaps you grab your coffee. You go to Starbucks before you go to office. See what I mean? So perhaps you went to McDonald's for a breakfast before 9 o'clock. Multi-purposes as well. So that's the reason denied. Now what about office to office then? Office to office deductible. Provided the expenses office to office wasn't reimbursed by your employer. Now, you have regional duty as a supervisor, okay, look after Wongkok, all shops, all the retail shops and Kowloon Peninsula. Okay, talk about hundreds. So during 9 to 5, so your duty to visit all the shops and you pay transportation costs. So those will be deductible. Again, provided it's not reimbursed by employer. Okay, follow the premise I talked about. So if it's so necessary for your employment, for you to discharge your duty, so it must be, or it should, or better be, paid by employer. Now, if it end up the employer did pay back, no deduction, apparently, because you did not incur any expense on your own. Okay, you get paid back. Payment in lieu of notice. So from this situation, we'll talk about in lieu of notice, so we are talking about what? Employee actually what? Early left the existing employer. Then we'll talk about expense, correct? A lot of people confuse the other way. Now, if there's an employer would like to get rid of the employee, it's not a deduction issue, it's an income issue, which we talked about last week. It was, okay, starting Fuge case. But we turn our attention now, it's a deduction, so we've got to fix the correct situation. Essentially, we talk about employee would like to leave their existing employer early and then compensate their existing employer by 1 month pay. So the pay for 1 month back to the employer, deductible or not? Answer is not deductible because apparently you have a choice. You have a choice. Employer get rid of you, there's no choice. Agree? But oftentimes, if you decide to leave early, so you can actually leave within a month, not right now. Okay? Business suits. Business suits. I pay 5,000, okay? And I bought whole suit, okay? 5,000. Is it deductible? It may be wholly, it may be necessarily required by an employer, but it may not be exclusively. Okay? Some practitioners argue, and actually, we need to wear something to start with. Okay? All right? I don't think anyone will just naked and walk out of the house. Okay? We need to wear something to start with. Being a suit or business suit, no matter what suits we talk about, so it's multi-purposes already, more than one reason. All right. And some of the argument also argue is not incur in because you purchased that suit before you on board or report duty. It's not incur in. So a couple of other issues that I would like to walk through with real life situation, for example. So what about uniform? I'm sure you guys know what uniforms are. Okay, so we have workforce like policemen, firemen, immigration officers, McDonald's, Pacific Coffee, uniform. Okay, so employee pay for a uniform 1,000. Is it deductible? So I would argue it's deductible because it's different from a suit. Suit you can wear for other purposes, but uniform I don't think you wear your uniform and then watch a movie with your friend. Okay, with practical consideration. Okay, but again, the uniform if it's paid by employer, no deduction. And what I can assure you, so all these organizations or units. So whenever a so-called really uniform is required, okay, by work, by employer, so 100% of the time, I will even confident say 100% of the time, so the cost of buying that uniform actually paid by employer. Paid by employer. Which get into another discussion. What about laundry expense? Laundry expense. So what about washing the uniform? So while day by day you wore it for work, then you need to pay laundry expense. Deductible. Laundry expense deductible. Again, if it's not reimbursed by employer. So it's an agreement that you paid and you don't get reimbursement, then it's deductible. Laundry expense on uniform. On uniform, huh? But if some of you have a little doubt, why under employment situation the employer did not reimburse? Now, good question. Now, what I can share with you, the answer to that particular question is, so we do have a certain number of employees actually work under commission base. Commission base. So that means under this sort of commission-based employment, the capacity as an employee, like an agent, then the employee actually required to run his or her own profit and loss, even is under employment. What does it mean? That means the supervisor is going to make the rule of the game like if you're commission-based, then your commission income could be maximized if you are able to minimize your cost. See what I mean? Okay, so to give certain degree of freedom to the employee or agent so that he or she, as I explained, he or she as an agent run a little so-called profit and loss on their own. So with a good reason behind it, and then let the individual employee agent to minimize costs and maximize their income. And then there's no reimbursement. Then in that case, deduction is allowed. One last thing, professional body annual subscription, a number of qualifications got to share with you. Number one, full membership, full associate membership. Okay, not student membership, but full membership. That means pass the exam plus relevant experience required by a particular professional body admitted as a full member. Then the annual subscription paid yearly will be deductible by concession. So please add concession. Concession. So it's particularly relevant because it's my job to really explain the exact knowledge. So it's not deductible under the general rule. It's not deductible. It's not. Because again, it's not exclusively. Again, it's not incurred in the production. Okay, you took the exam, and then you admit as a member, not incurred in the production. So it should be denied, but by concession. By concession means practically the IRD would willing to give way, okay, as if it's deductible, to address the business needs. Address the business needs. What kind of needs? So allow the corporate employer to recruit a greater number of qualified talent as employees. All right? So I will get a deduction. I'm willing to join a particular professional firm if my professional status or membership actually is a prerequisite, okay, a precondition. CPA firm, for example, consulting firm, for example. Now your membership will be deductible. Will be deductible. So normally the firm will not reimburse your membership fee. Then you deduct. Okay, so limit to one. If you're multiple membership, deduct the most expensive one, because it doesn't limit to local professional body. Okay, you have overseas membership, ACCA, CPA Australia, some other, or apart from HCA CPA, then you can claim one. But it doesn't limit only to local. You can claim overseas, so long as you're admitted already as a full member. And you can switch one after another. So this year I claim ACCA because ACCA was the most expensive, for example. And then next year you claim ICPA. It's possible. But make sure you keep all the invoice and receipt. Now we move away from general rule and start to look at individual, itemized deduction, which should give you a sense of it. So if we pull out this allowance deduction and rate sheet again, so it's allowance, which we will soon talk about in next class. And right now we start to look at the itemized deduction, self-education expense. Okay, and a bunch of this accessory deduction down below. All right, so make sure I do not lose any one of you. self-education expense. Now, the legislation idea behind it is encouraging the taxpayer to subscribe this idea called lifelong education. Okay, with a good reason under this deduction. Encourage the taxpayer to upgrade themselves through a structured learning. Structured learning exhibit itself through two ways. Number one, taxpayer paid a tuition fee to recognized educational bodies. By saying recognized education bodies, so those are institutions recognized by law, education, okay? Most of them, if not all, actually governed by the Education Bureau and the respective ordinance, like the universities. Okay, I told you each of the university actually with a separate legislation that talks about the requirement under the governance of the university, like CUHA ordinance, HAUSD ordinance, Hong Kong U ordinance. So university, including also technical college, VTCs, vocational training college, but exclude capital expenditure, okay, so that require you to pay data service or require you to pay a vacation, no, not vacation, as a touring trip, okay, some of the MBA program actually part of the curriculum, so which they jointly will fly overseas and then build the network. So the air ticket, hotel accommodation, denied. Follow? Only tuition fee. Only tuition fee. Now this is one hand. On the other, exhibit itself, so-called lifelong learning. So instead of going through this economic program, okay, taught program, no matter talk about taught masters, MBAs, EMBAs, so we have gaining learning or education through professional exam, okay, professional exam. So it connects to exam fee and the fee paid on prescribed course of education. Now, prescribed course of education actually talking about those programs organized and offered by professional bodies, okay, including the pre-training program like HCICPA. But HCICPA will be pre-training program for student members. So we are talking about other workshop, let's say, workshop, or seminars, okay? But seminar is not course of education. So workshop, so mostly workshop, prescribed course of education. And the exam fee, well, it includes exam fees. The exam fee paid will be deductible concerning the prescribed course of education. Okay, organized and run by professional body, including their professional exam. Including a professional exam. Okay? Prescribed course of education. All right, so university tuition fee, exam fee in prescribed course of education like the pre-training program, workshop, exam fees. So will be another way, taxpayer paid exam fee on those, deductible. So either route cover both tuition and exam fee. Now, one thing you need to pay attention is the requirement under undertaking the course. Okay, so there were board of review cases where the taxpayer actually passed the assessment component, passed the examination, and claimed the exam fee and tuition fee. And it was denied because in the fact-finding process, the assessor actually discovered, so they did not undertake the course at all. By understanding, what does it mean by undertaking the course? Attendance. So attendance, a reasonable level of attendance, so talk about 70 or 75%. Okay, 75, 70% of attendance required as a evidence the individual taxpayer actually undertook the course. Okay, so something I need to remind you. Undertaking is an essential requirement. Okay, they were taxpayer actually met the assessment component. Okay, submit the homework, submit the assignment, pass the exam, claim the tuition fee, but fail. Undertaking is an essential requirement. So leaving behind will be maintain existing employment or gain planned employment. Now, maintain existing employment, current employment, I think is easy to understand. So long as the taxpayer did not undertake a leisure course or a self-interest, not self-interest, taking an interest, okay, as an interest, like language, like flora, okay, how to set a basket of flower, okay, so it's in a good-looking way, or drawing or painting, okay, or yoga. These are all denied, okay? It's a personal interest. So long as they are not personal interests costs, okay, not personal interest courses, then you're able to argue it's maintain current employment. But gained planned employment, that is challenging. Why is challenging? Because we're talking about planned employment. That means we look ahead, your future employment. So you undertook a course and you argue it's really for the future planned employment, then it's difficult to draw the boundary. Okay? So how far our argument could reach, then is something interesting. I can't give you a definition, but I can share with you a few board review cases to give you an idea. Then you make your own judgment. D138 held in the year 2000. Taxpayer was a policeman. Okay, so probably he undertook a course by Hong Kong Academy of Arts, I guess. He paid for a course. He learned Chinese opera. Okay, argue. So he would like to change employment from a police workforce to a performing arts individual. Denied. Too remote. Second, similar, D8206. Taxpayer was a lawyer. Okay, this time is a solicitor. She paid for a course that allowed her to learn acupuncture. Do you guys know what acupuncture is? A Chinese medicine practice using needles. Acupuncture. Again, denied. Okay, argue change from legal practice to medical practice. Too remote. Okay. Now pay attention, we have the third medical school in Hong Kong, okay, right here. Admitting second degree, so maybe this thing could be argued, okay? Because they claim starting 2028 will be the first batch of admission, so admit second degree. If I got the message correct, so they even admit first degree from arts or something. I can't believe an art first degree can undergo medical training. I don't know. Correct me if I'm wrong. That's what I heard. Okay. Don't worry. I don't plan to do that. Okay. You won't see me as a doctor in front of you. Okay. I can't do it. You don't need to be afraid. Simply, I can't do it. Okay. Get the idea? Too remote. Both of them. Both the review cases help us to understand what does it mean by gained planned employment but held as denied. Reason, too remote. Self-study expense, denied. That means I sit for the exam, I can claim the exam fee. Under this one, exam fee okay. But the cost I spent to purchase self-study reference book, not okay. Self-study reference material, exclude. Deduction limit, 100,000 a year. And then deduction granted, but subsequent reimbursed. Again, the same principle. We've learned and going to use it, have been using it a couple of times. So it's about clawback, C-L-A-W. C-L-A-W. Okay, let me say it again. It's not C-A-L-L. C-A-L-L is wrong. Claw. Okay, the exact technical term, C-L-A-W. Clawback of deduction. So that means a return of deduction. Okay, I explained a couple of times. So I deduct self-education expense 2 years ago. Now I get a reimbursement from CEF, Continuous Education Fund. So the amount reimbursement should be reported as an income. Let's say I receive it this year. So I report to the assessor, okay, within 3 months from the date of receipt. Then upon receipt of this information, the assessor will raise additional assessment, okay, going back 2 years ago. Now, the idea of going back to the relevant year, so it's about the accrued income. So we need to go back. Why we need to go back? The difference is 2 years ago when I obtained the deduction, the rates are different. Tax rate could be different. Allowance amount could be different. Deduction limit could be different. So everything prevailing the law 2 years ago should be used, rather than simply get taxed in the current year. See what I mean? Agree? So that's the reason, the answer why the additional assessment this time will go back to the original year of deduction. Okay? Stop me at any time if you don't get what I just talked about. Now we talk about donation, okay? Running down the list that I pointed out, okay, a couple of minutes ago, down the deduction list. Concessionary. So one of the concessionary deduction, not Section 12(1) deduction, but they are given as a allowable deduction because these deductions is going to be doing a greater good to the Hong Kong community as a whole. Donation is a good example. Now, if you afford to donate to help the needy people, then the government actually acknowledge and help you a bit by offering deduction extra. Okay? So it's certainly not wholly excluded necessary incur in. Certainly not. But as a taxpayer, you afford and then you're generous enough to donate and help other people, then acknowledge, okay, this good behavior by deduction. Okay? Motivate. A couple of deduction criteria. First one, tax-exempt charity. So talk about the receipt of the money from the donor. So the donee identity is important. Okay, I donate money to my friends. Okay, helping my friends, no, because your friend actually not an exempt charity. It must be in money. If I donate to approved charity in the form of commodity like a van, okay, earlier in the board review case, one of them, taxpayer donate a van. Okay, talk about 200,000 Hong Kong. The taxpayer claim a deduction but deny because the law mentioned it's a donation of money. You can keep on donating commodity so long as the organization needs those commodities. It's a good thing to donate commodity. But if you're concerned about deduction, then see if it's possible you arrange a donation of money. Okay, donation of money. And the amount of money in aggregate, each time you can donate whatever amount you want, whatever amount they need. But combine, again, if you want to get a deduction, April to March, combine all the deductions you've made, make sure, okay, not less than 100. Not less than 100, combine. Exempt charity. What are exempt charity? Something I need to discuss with you. So if they are not big enough to draw your attention, so why don't I make it bigger? Now, after you graduate, please, okay, donate to your alma mater. So we need your money to make the university a better place. You can get deduction. Okay, it's a Gazette list. List all the approved tax-exempt charity. So that means a bunch of these donee receive the taxpayer donation, okay, required by some other condition that we will soon talk about. Then Hong Kong USD actually one of the exempt charity. It's a charity, but not just Hong Kong UST, but Hong Kong UOC, UHA, Why? Now, this is the time to expand your understanding about charity. Essentially, we have 4 parameters that we consider is a charity activity or is a charitable organization. The best known to everyone will be alleviation of poverty. Poor, help the poor, poverty. So alleviation of poverty. Now, if you're born and raised in Hong Kong, you know community chest, 公益金. Okay? Dongwa Group of Hospital. Okay? 保良局. Okay? So, Caritas, 明愛. Okay, these are non-approved charity. In particular, help the poor, a Red Cross. All these university institutions also qualify as a charity for tax and legal purpose because charity doesn't limit itself as alleviation of poverty. So it also includes advancement in education, something you might not know. Advancement in education. That explains, that makes Hong Kong U, CU, Poly U, CTU, USD. So they are all approved charity. Advancement in education. And third one, likewise, advancement in religion. In religion. Okay? 聖公會, Catholic Church, Buddhist, advancement in religion. So long as they applied and recognized and approved by government, so they would become one of the approved charity on the list as tax-exempt charity. So the other one will be the government deemed as appropriate. Okay, so major 3 elements are alleviation of poverty, advancement in education, and advancement in religion. Okay, so after you graduate, you donate money not less than 100, approved charity. Then without benefit in return. Now, this bullet requires a pure donation. This is something I would like to explain. I would like to get the idea. P-U-R-E, pure. Pure donation is a common law requirement, okay, handed down by the judges in Sanford Yung case. Sanford Yung, the founder of Coopers and Lybrand in Hong Kong, so back in the 1970s. Okay, these founding partners actually bought four evening show tickets, the whole event organized by an approved charity. He bought 4 tickets, talking about 5,500. He claimed a donation because it's an approved charity in money, not less than 100. But the ILD argued, as a taxpayer, Mr. Yung, he paid 5,500, allow him and his family and friends in that occasion enjoy the evening show. It's a variety show. It's a show. It's an entertainment show. So the ILD argued it's not a pure donation. It's not the interpretation or legislation aim of that provision. So the case actually brought to the High Court. And actually the ILD won. So it's an extra case law principle added to, in money, not less than 100, donate to approved charity. Then now, after the Sanford Yung case, we realize and understand, so it must be a pure donation. Pure donation. No benefit in return from the donee. So donor essentially make a one-way generous contribution called donation, pure one, then deductible. Okay, learning from the Sanford Yung case, even an entertainment show will void or destroy the deduction. Now, in the class, I really want to extend these arguments and principle. I'm hoping that it let you get a better understanding. Now, talk about pure donation, no return. Now, entertainment show. So we learned from Sanford Yung case, no question asked, now denied. Then what about raffle tickets? Do you know raffle tickets? Or you go to a bazaar, you know what bazaar is? So it's usually held in an open open space, open door. So it's a gathering event that allows you donate and then you can get some souvenir or something. Okay, so you can spend an afternoon or evening. Raffle ticket could be a donation, so you buy that ticket, and at the back, okay, which comes with lucky draw, okay, the first prize, holding that ticket number. After the lucky draw, then the bearer can actually win a ticket to Japan. Deny. You cannot argue with the assessor, I did not win that prize, so no benefit coming back. Now, giving you a chance to win a lucky draw, it's a benefit. See what I mean? So, deny. And even now, these days, I observed the raffle ticket, even, okay, very practical. So they actually attach a $2-3 coupon that you tear it out and then you can buy to Circle K, Maxim, or even Hong Fuk Tong. Deny. Get it? Any objection? Now, even if I donate money to a church or something, and then I was arranged, okay, reserving my graveyard. Okay, you guys know what graveyard is? I end up ending there. Okay? Deny. Okay, so donate money with an arrangement to reserve my graveyard. Deny. Final challenge. So our business school, actually, what's the name of the business school? Our business school. Do you know? Really? Li Xiaogei, okay? Li Xiaogei, donate. And then his son, Martin Li Jiasing. Not the Chang'an Li Jiasing, but Li Xiaogei's son. The Innovation Tower. So they contribute and donate money, help us to build, okay, advancement in education. Blah, 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 blah. So all the way down to, was it deductible? It comes down to the question, what do you think? A pure donation or is not a pure donation? Okay, Martin Li with this size wall. Li Xiaogei 商學院 this size wall. What do you think? Deductible or not? Do you guys ever been to LTA? Certainly, yes. Okay. Don't tell me your second last year and last year study, you've never been to LTA. Huh? If you look at LTA at the back of the seat, anyone ever pay attention? Their names are at the back of the seat. They are donor graduates. So they donate money with the name, okay, engraved at the back of the seat. Donor. Deductible? Not deductible? What do you think? Deductible. Reason. Now, those who would like to or attempt to argue is a benefit return because of recognition, because of fame, okay, because of with this big name, okay, enjoy this sort of recognition. But let us discuss. Do you think Martin Li and Li Xiaogei, they need reputation? We don't know him. I don't think so. Okay? Second, there's no reliable objective measure, which is different from a variety show, because there's a so-called variety show. Actually, it's a market for this, correct? Even though we actually, it's quite hard to find a comparable scale of entertainment show, but in fact we can, okay, benchmark with some sort of, okay, so this class of performer, things like that. So it's measurable. But about fame, about name, there's no objective, reliable measure. Second reason. Lastly, I purposely asked anyone actually ever been to LTA. Those you've been to LTA and you realize and you're aware there's a name at the back of the seat. Okay, by show of hands, anyone remember any name? No. So deductible. That means what? It's honestly, genuinely, it's out of generosity. That means Even some bad guy like me, I would like to donate, okay? I would like my name on the back of this LTA. I would like somebody know me. I'm sorry. No one's going to pay attention to that. Okay, very practical, very interesting. Real life example. Deductible. Now, if it's deductible, then it's a deduction limit, 35%. 35%, the formula, again, kind of, you need to remember. So it's an idea behind it's assessable income, only take away wholly excluding necessary deduction. Just wholly excluding necessary. Okay, if you claim depreciation, before depreciation. If you claim self-education expense, before self-education expense. So this one is actually in favor of taxpayer. Because if we talk about 35 on something this size, if it's before depreciation, before self-education expense, that means bigger. 35% on something bigger, that's what I call in favor of taxpayer. Agree? That's help you to recall. So the formula actually 35% just after wholly excluding necessary deduction. And any other deduction else before that. Okay, with the result, the taxpayer actually will be able to get a bigger deduction limit, which is something good, I would say. Elderly residential care expense. Okay, just walking down the list. Okay, bear with me, it may not be as systematic as you expected, but we are going one after another. If you find something you can't understand, let me know right away. Now we run down to elderly residential care expense. Now it came into picture, the provision itself is one of the many measures, one of the many incentives that actually take care of the taxpayer financial burden in light of what? In light of aged population. So on the one hand, there's a growing aged population, something we can't stop, but at the same time, we have worked taxpayer, okay? So with full-time job. So it comes out with a very genuine social issue. The elderly, the aged people, in particular, if they need medical attention, they need paramedical treatment, okay? Then it gets down to the idea the taxpayer paid elderly residential care home expense to take care of the parent and grandparent. Parent of taxpayer, grandparent of taxpayer. To the licensed care home. So under this governance, the government, in fact, under another piece of legislation called Elderly Residential Care, in bracket, Elderly People Ordinance, Chapter 459. So under this separate piece of law, we have a group of registered care home. Taxpayer paid expense to this registered care home to take care of their parent and grandparent, they will get deduction. They will get deduction. Okay? For each qualified dependent, which soon I will share with you what are the qualification conditions. But this is, again, my job to remind you. So we have two adjustments. One will be the allowance, which we will talk about next class probably. We'll talk about the part 3, look at a bunch of allowances. The top part of the page, allowance rates and deduction. Okay, the rates sheet that I showed you. So we're going to talk about the first part, the allowances, next class. And then another thing is the thing that we talk about right now, dependent grandparent allowance. They are precluded from each other. What does it mean? That means taxpayer in the year of assessment, in 1 year of assessment, taxpayer claim DPA, taxpayer cannot claim the elderly residential care expense in the same year. So they need to separate them. Later on, I will give you a numerical example to illustrate this point. So the idea is they are mutually exclusive in one same year of assessment. That means the taxpayer either choose to claim depreciation, claim the elderly residential care expense, or taxpayer chose to claim allowances, not both. Qualified dependent. what's specified on this page. Recipient care, that means the aged parent and grandparent, reached the age of 60 in the year of assessment. Aged requirement. Age requirement. So long as the birthday of the 18th year fall into any day in a particular year of assessment. Give you an example. If 24-25 year of assessment, my dependent parent actually reached the age of 60 on March 31st, 2025. March 31st, 2025. So we know there's the last day of 24-25. So in the year 2024, in the year 24-25, the money I paid already qualified. Okay, one day in the year of assessment qualified and reached the age of 60, that year of assessment good enough for the taxpayer to claim the deduction. But under 60, then the dependent qualified to receive a disability allowance under the social welfare scheme. Now, this is a separate subsidized scheme to help the people who mentally or physically disabled, and then the government under the disability allowance scheme will grant an additional allowance to these people proven as disabled, okay, no matter physically or mentally disabled. Now, if the dependent happened to be one of those eligible for this disability allowance, then the age requirement will be relaxed. Now, I call them as an age requirement breaker. Okay, this is something I use in the classroom. Okay, and then in order to tell my student, first of all, there is a basic requirement on age. Basic requirement on age. That means the dependent should reach the age of 60 in this example. So if the dependent actually 59 only until next year reach the age of 60, so current year, no deduction, because it's the age requirement under the law. Okay, so there's an idea behind deduction requirements. Either you meet your deduct or you did not meet it, or meet the requirement, you're not entitled to get it. But oftentimes there will be breaker on the age requirement, like disability. Okay, again, so this idea is going to come up to us again in other numerous occasions. Talk about where age breaker actually relevant. Our job as a CPA or as a tax representative, we are not medical practitioner, so we can't certify the disability. So our job is really check the genuine certification, okay, the proof documentation as a proof. So when we check and look for those evidence, okay, then we will relax the age requirements. So in this context means even the grandparent or parent, age 55 or 50 even, but proven as disabled, with all the document certificate proven as disabled, then the amount the taxpayer paid to elderly residential care expense still okay, still deductible, because with the age breaker that I've been talking about. Deduction limit, 100,000 for each qualified dependent. So I paid a registered care home to take care of my parent, father and mother. I can get 200,000 as limit. Okay, for each qualified dependent. Father 100,000, mother 100,000. Okay, each qualified dependent. But the deduction is restricted to one person for any year of assessment in respect of the same parent. Okay. This time, anyone in the room volunteer to be my example mother in the classroom? Okay, so in the classroom, mother, my lovely brother. Okay, so this mother with two sons, okay, elder brother, apparently elder brother. Why don't you play elder brother? I'm younger brother. Okay, so mother. Okay, we paid, and then you live in a licensed care home for whatever reason. There's a genuine need. The elder brother, your elder son paid 10,000. Your younger son paid 8,000. Okay, 10,000, 8,000. Okay, same parent, restrict only to one taxpayer. So either he claimed 10,000 or I claim 8,000, but not 18,000. The deduction is restricted to one person for any event instead of same parent. Okay? So we need to come to a compromise. Okay? So reasonably speaking, so he paid 10, I paid 8,000, of course, claim the larger amount of deduction. Okay, then we sit down and then take a compromise. So this is what the last bullet means. Deduction is restricted to one person, any year of assessment. The next year depends on how much we're going to pay, then we can switch the taxpayer who claimed the deduction. But so long as the rule is restrict to one, in respect of same parent or grandparent. Now, it comes down to a very interesting question I received a couple of years ago. So one of the students asked me, is a parent-grandparent, does it cover grand-grandparent? Is there a name for grand-grandparent? I don't know. But you understand what I'm talking about, right? So it's the father and mother of the grandparent. There's a grand-grandparent. Answer is no, they are not covered. Because the law specified parent, grandparent. Okay, so we can't exert interpreting the grandparent under the law actually cover more generation above. No. Grandparent will be the parent of your parent. That's all. Okay, which I think is very interesting. A good, valid question. Which gives me a chance to clarify. Okay. As I said, so how do we understand this bullet? LD residential care expense preclude depreciation. No, preclude dependent parent allowance. In fact, it's a very simple example. In same year of assessment, 2021, taxpayer paid elderly residential care expense, and the amount was $100,000, 3 months, April to June. For some reason, starting July, the rest of the 9 months, the taxpayer was able to live continuously with the parent, at least continuously for 6 months, which next class you understand is a basic requirement under the dependent parent allowance or grandparent allowance, giving the taxpayer actually reside with the dependent continuously, not less than 6 months. Taxpayer will be able to get the basic allowance of $50,000 a year. Okay, take it as it is. So in other words, it gave the taxpayer with the situation that taxpayer paid elderly residential care expense, at the same time qualified to get the $50K as a dependent parent allowance. Just happened, the law preclude both things happen or available to the taxpayer in the same year of assessment. In the same year of assessment, taxpayer will not be able to get both. So either they choose the deduction or they choose to get the allowance, but not both in same year of assessment. So that means the next year start afresh, then the taxpayer can choose again. But I would say under this case, more likely than not, then continues to live with the parents, I guess. So 21, 22, probably the taxpayer will claim only the dependent parent allowance. But for 2021, in this situation, the taxpayer will not be able to get both. Will not be able to get both. Okay. But if you were the taxpayer, what would you choose? I know it's not a fair question because we have not talked about allowance. So anyone would jump start and say, I will go for deduction because apparently 100,000 bigger than 50,000. I will not say you're wrong. As I said, it's not a fair question, but I will leave it open because after we talk about allowances, actually we can get a better discussion about this. But apparently, without any other information suggests otherwise, I will go for 100,000 deduction as well, because apparently 100,000 bigger than 50,000. Right? One thing I would like to remind you though, which you have not learned it, but if you remember, then afterwards, after we talk about allowances, so it gives you a better idea. So what exactly the issue is about. Deduction. You can get deduction once you have assessable income. Okay, deduction. But allowances, if your income is not big enough to cover the allowance, you will lose the allowance. All right? You will lose the allowance. So that means if you have an income, so after you get 100,000 deduction, at the end, your liability actually smaller than you go for deduction, which is something you may not understand 100%. But after we talk about allowance, we'll come back to this issue. So there's a choice between deduction and allowance. There's a choice. So it depends on the taxpayer income level a lot of times. Home loan interest. Home loan interest. Now, it's good, I think, always, I believe, giving you the legislation background about something about the history of it will help you to better understand the issue that we're going to talk about. Now, home loan interest, it came into effect in year April 1st, 1998, as a direct response to the first Asia financial crisis that happened in the fourth quarter of 1997. Okay, it's a big hit to economies in Asia. Hong Kong was being one of them. And then what's the effect, what's the impact on taxpayer in particular? So we have a work class for the group of taxpayer. So they bought their house for residential, not for rental, not for speculation. Just there's a genuine need after they get a lot of them. Okay, newly formed a family after marriage, so mid-1997. The worst will be September 1997. So they bought a house under mortgage. So that means they borrow from the bank. Now, after the financial crisis that hit Hong Kong, the property value, plummeted 60% on average. So something what people call is a negative asset. What does it mean by negative asset, accounting student? Your liability actually greater than your property value. Okay, your unpaid principal from the mortgage loan actually $1 million. But after the financial crisis, so your property value actually down to $400,000. You have $1 million loan, but your property value $400,000. There's a tough situation because if you sold your property, actually you still need to find extra funding to pay off your loan. Now, against that background, the government actually one of the many measures, so hopefully to alleviate the burden financially of the taxpayer by introducing a deduction on the mortgage loan interest they pay to finance their principal residence. Single purpose, help them to finance their first home, not rental property, not second home, not any other financial needs for some other purpose, just sole purpose, only objective. So help the taxpayer to deduct the mortgage interest on their principal residence. Now, I keep on saying other situations like financing for other reason, for rental property. So these are not eligible for deduction because so it deviates from the main purpose of the legislation, which is helping the taxpayer to pay less amount of tax payable by deducting the mortgage interest. So the interest on mortgage interest are financing the residential property, the principal residence, not rental, not refinance for some other reason. Now, refinance in some other reason means a situation where I pay off the loan already, first time, pay off the loan, pay off. And then for some other financial needs, I use the same property to refinance. That is refinancing. Do you all agree it's not because I have problem to finance my first principal residence, because I did it. But after I own that house, after pay off the loan, I have some other needs. Okay? I would like to run my own business. I need capital. I have a pay-off property. So why don't I use this pay-off property as a mortgage and then refinance it? You can do it, but you won't get the deduction again. Likewise, if you have property A and B, A will be your residence. B, you own it, but you use for rental income. You're paying mortgage interest on both. You can only deduct on A, not B, because it's your rental property. So finance your residential property in Hong Kong. If you finance a third one overseas, sorry, nothing to do with the home loan interest, because it's not a property situated in Hong Kong. Okay, simple reason. So all these acts, you always can do that, but you won't be able to get a home loan interest deduction because it's not meeting the deduction criteria. Person, the taxpayer, either own the house, the property by himself or herself, one owner, or more than one owner, then we get into the ownership alternative, joint tenant or tenant in common. Later on, I'll come back and explain what it is. And then the taxpayer borrowed money under mortgage loan, a mortgage, a specified loan arrangement where you use your own residence as a pledge, as a security to obtain X amount of dollars and pay off your residential property. And as I mentioned, it restricted to residential property that taxpayer purchased and which was located in Hong Kong, not overseas. Only one principal place of residence, A and B, okay? Both of them your residence. Both of them you pay mortgage. Okay, you pay mortgage interest on A, let's say, both of them in Hong Kong. A, 60,000, B, 40,000. You can't claim both because only one, principal one, 60-40. So which one you will claim on? 60-40, 60, right? Bigger one. But is it the ultimate correct answer? It may not be, because you have not proven it as your principal. You chose it simply because if I were you, I will also choose 60. But 60 is a bigger mortgage interest amount you paid. Okay? I'm not saying you're wrong, but I would like to point out principle. What does it mean by principle? So A and B, then you need to prove which one was your major residence. That means you use it mostly. A lot of time it's tempted to use duration. Okay, duration, live longer. Okay, 6 months. No, 9 months versus 3 months, etc., etc. So 9 months. Okay, probably you're able to argue it's principle, but it's not the most objective evidence. So if you say you claim A, 60,000, and you claim you lived there for 7 months, as an assessor, would you like to ask any sort of question to obtain proof? Okay, to prove the taxpayer actually did submit a correct return? Knowing principal place of residence for that property will be deductible, the mortgage interest, not the other one. Practical consideration is looking at their utility consumption. Utility consumption, something very practical. Okay, so you're an assessor, you're an advisor, so you negotiate or not negotiate. You will discuss with your client, and then better prepare to your position and defend. Look for objective evidence to prove. Now, if you're able to prove A, 60,000, you live 7 months, but at the same time your utility consumption show, so actually you live way more than B, then probably certainly you'll win. All right, utility consumption. Another qualifier will be your lender identity. So you must lend. No, you must borrow. I'm sorry. You must borrow by prescribed lenders. So apparently those FIs, banks, so they legally arrange mortgage loan product, also include government or semi-government agent like housing or society in Hong Kong. So some other semi-private, subsidized housing. So if you borrow from housing society scheme, which I did, 20-some, 30 years ago. So I paid mortgage interest on that property. I was able to get home loan interest. Interest actually paid in the year of assessment, maximum 100,000. But 3 years ago, with an objective to encourage taxpayer to give birth to child or children, so it's an extra bonus of 20K each month, provided the firstborn actually on or after this date, the proposal date from the government. And the taxpayer resides with the child not less than 6 months a year continuously. And then next page, I provide you other information like the extra deduction 20K actually available up to the child reach the age of 18. Extra deduction as a bonus, as I said, to encourage taxpayer to give birth to a child. And in terms of living expense, like mortgage interest, give an extra 20. And the deduction actually, with a time limit attempt, 20 attempts. And this 20 attempts is done by way of election. So that means the taxpayer can elect 1 year and stop another 2 years, whatever pattern that the taxpayer consider appropriate for them. They can always kickstart or stop any year of assessment they would like to claim, or wait until another year to claim the home loan interest. It's up to their wish. It doesn't need to be continuous, it doesn't need to be consecutive. So long as for a taxpayer 20 times in each year of assessment. Now, a person may nominate his or her spouse to claim the unclaimed mortgage interest. Underline, provided that person has pay more attention, no income at all, subject to tax. By saying no income at all means all income taxes in Hong Kong. No salaries tax, no property, no profits at all. So literally, we're talking about a housewife or a house husband. No income at all. And the deduction limit, again, pay attention to the deduction limit, shared between joint owners. Now, the limit shared, not the amount shared. A lot of people get it wrong. In particular, in the following example. If the couple elect for joint tenant, they incur 120,000 mortgage interest, 120. So deemed as equally shared. First of all, 120 deemed to be equally shared, 60-60. Follow? Was 60-60 as the answer, shared between the two? 60 actually below 100,000, 60 below 100,000. Can they each one of them claim 60? Answer is no. We are wrong. Because what we did was we split the amount paid. We did not split the limit. So if we split the limit, it should be 50-50. Follow? So the answer should be 50-50, not 60-60. Because if your answer is 60-60, actually you ignore the deduction limit. See what I mean? In fact, pretty clear. Deduction limit share. So very certain, 50-50. And this is the extra bonus, as I mentioned, 20K. Valid for the taxpayer actually gave birth to a newborn this day or after. live with the child in Hong Kong not less than continuously 6 months, and up to when the child reaches the age of 18. I don't want to rush, as again, there's no point in rush. So about joint tenant and tenant in common, we will talk about Friday. So I'll write it down. And then afterwards, we pick up from MPF. Okay, I've written it down, so there's no chance I'm going to miss and forget it. Okay? See you Friday.
To clarify, slide 28,
28. Oh. Hi.
I don't think we have this.
Oh, yeah. Okay, so about the extra bonus of the 20K. So I will upload the update version. Okay, so update version. Thanks for helping.